Welcome back. This week, economic growth takes a center stage as key PMI data prints set the scene for economic conditions amid changing tariffs and geopolitical environments. Joshua Mahony, Chief Market Analyst at Scope Markets, joins us for a preview of the global economic week ahead. Thank you so much for your time, Joshua. Now, after the markets had an all-out meltdown for weeks on tariff threats, are the waters calmer now?
But it's certainly a feeling that potentially they've priced in the worst. Over the weekend, we heard from Donald Trump, and he's essentially alluding to the idea that whilst they are going to implement the reciprocal tariffs on the 2nd of April, the sector-specific bits may not necessarily come then. So people thinking, oh, great, okay, it's not as bad as we think it might be. But in my mind, it also provides the possibility of another deadline down the line for everyone to start worrying about once again. So it's almost like one thing leads to another, leads to another. First, it was Mexico, Canada, China. Now it's reciprocal tariffs. And now potentially the sector-specific stuff when it comes to pharma and automotives possibly happening down the line.
Well, let's drill into automotives because Hyundai, which is a South Korean company, is gearing itself up to invest $20 billion in the U.S. Is this a trend that we are going to be seeing from non-U.S. companies as they try to avoid tariffs as much as possible?
Yeah, exactly. I mean, look, this isn't the first time we've heard from foreign companies investing in the US, standing alongside Donald Trump, which is something we're expecting to see today from Hyundai. We've seen it from SoftBank, we've seen it from TSMC, and essentially this onshoring process typically appears to happen with companies that already have a massive vested interest in the US. And on this occasion, it's a case of saying, okay, we're going to build the steel needed for the plants that we've already got in the US. So I don't necessarily think it's going to be the last. And ultimately, this is music to the ears of Donald Trump. And it does point towards the fact that whilst right now we're talking about China being the new area of strength or Europe being an area of strength because of the investment that's going to be happening there. Ultimately, once all is said and done and maybe we've got some agreements on the tariff front, I do think that sort of US exceptionalism story is probably going to come back to the fore once again down the line.
Yeah, quite interesting. And really, this plays into Donald Trump's chess game because, I mean, just by dangling these tariff threats, now you have these companies investing more of their money in the U.S., which is absolutely fantastic for the U.S. Let's talk about the PCE inflation figure that we are expecting on Friday. Of course, the Personal Consumption Expenditures Index, which is the Fed's preferred gauge of inflation. What kind of insight into the inflation trend are you expecting from the PCE?
I mean, look, ultimately, this story around stagflation is absolutely key at the moment. So markets are pricing in the idea that the Federal Reserve is going to play a little bit looser if they're greeted by weaker growth. But the one thing that ties their hands, of course, is inflation. If we see inflation on the rise, then that means that we might have a worst case scenario where we have high inflation, weak growth, and therefore the Federal Reserve can't step in. So the ability to keep inflation low is key. And that's why a number of the different things that Donald Trump has done since he's come into power, in my mind, are geared towards keeping inflation low. He knows that's the key to all of this, right? So the core PCE metric is going to be key for that front. Markets are expecting it to actually rise this time around, 2.8 from 2.6. But it's notable that there's a key differential between the core PCE and the core CPI, which is much more elevated in nature. So the PCE figure has thus far provided the key to us to feel a little bit more optimistic that inflation isn't on the rise. And of course, we're still yet to see many of these tariffs come in, so it could get worse. So if we see it rising sharply ahead of those tariffs, we could see the jitters really return to the markets.
Yeah, and are we also more optimistic because, of course, this all leads to the direction of monetary policy, particularly after the statements from Fed Chair Jerome Powell last week?
Yeah, exactly. I mean, the key takeaway really, aside from the quantitative tightening part, which is also key because the optimists will start thinking, look, they're gearing up for QE again. But key to it is also the fact that Powell essentially said that he's willing to look beyond the tariff inflation. If it's a one-time only inflation hit, then he's not necessarily going to think that that's being entrenched into the economy. But that being said, you know, anyone would know that if you see a massive rise in terms of prices, as you would for the tariffs, then people are going to start demanding higher wages. People have to then start charging more for their products because they're having to pay their workers more. And it does go around in circles. So that inflation can become entrenched. But the Federal Reserve seemingly are willing to look past it, which is certainly music to the sound of Donald Trump.
Another phase of transitory inflation. We'll see where we end up with that. We have a number of purchasing managers index prints coming out globally, particularly from S&P Global. And actually, we did have one from Germany painting an improved picture in terms of business activity. Anything to note in that recovery, and maybe just what we could see as a general trend in these PMI prints, considering the kind of nervousness that there is around business activity and economic growth?
Yeah, I mean, it's been a really interesting day, quite frankly, on the PMI front. We kicked off with Australia, where things looked particularly strong. Then Japan looked weak. Europe, it was a mixed bag, because whilst we did see strength in terms of the composite numbers, which essentially just to wrap it all up in one, it was actually really the manufacturing sector that improved markedly, where services were weakening. And that could tell a story of the possible resurgence of manufacturing in Europe, and everyone starts feeling great about the places like Germany, which are, of course, very reliant on that. But you've also got the potential that this is people in the US in particular, and businesses in the US, front running those tariffs on the 2nd of April, getting their purchases in now, and possibly in a month's time we might see those numbers start to pull back. But of course, whilst we're talking about the possibility right now of huge infrastructure projects, huge defense spending, that hasn't actually been implemented yet. So we do have a secondary tailwind coming into play down the line for Europe. Worth bearing in mind that the trade commissioner from the EU is over in Washington tomorrow to talk to Lutnick about the tariffs. So there's a possible best case scenario where we see them ultimately having domestic spending kicking in at the same time that the tariffs are actually eased back because of an agreement that they have with the US. So we could have a sweet spot for Europe down the line if that comes together.
You're talking about a sweet spot in best case scenarios. Let's go to the opposite side of that spectrum, worst case scenario, digging into Turkey. Many economic indicators there have been in free fall after the arrest of a political opposition leader last week. How worrisome is the current political turmoil for the economy that really has not had a great time in years?
Yeah, exactly. I mean, it's the biggest protest we've seen in over a decade. And key to this is there's a feeling amongst people within Turkey, or certainly it appears to be the case, that this is an assault on democracy itself. This rings true to the kind of thing that we've seen in Russia over the years. When a political leader starts to build momentum, all of a sudden they're charged and put in jail, and suddenly they go away. Some countries appear willing to lay down and accept that, others not so much. And certainly Turkey at the moment, this uprising really has seen jitters within the markets. We've seen a collapse in terms of the lira, weakness in terms of stocks in that region. But then you have to essentially fight back against central banks and the government, because they've banned short selling. So we've seen a pop in terms of the stocks, and the lira's also come back a bit because of the implementation of some of the measures that they've sort of pumped money in to try and support the lira. So, you know, it's not as easy as saying, look at the turmoil over there, we're suddenly going to profit massively from the weakness of the stocks and the currency, because you're also fighting against a system, and a financial system that is inherently trying to stabilize those exact assets. But quite exactly how this is going to end remains to be seen, because they're saying that the judiciary are separate from the government and that they have nothing to do with it. That's questionable, but that would also mean that they'd possibly not necessarily pull back on the things that are currently in play at the moment. And if it's a long-standing issue, then again, it sort of brings into question the value of the lira in particular.
Yeah. Let me just bring in a question before we end off the conversation. Just even in South Africa, we have a number of companies that have exposure to Turkey, or that have had exposure to Turkey. And a lot of them are also pulling out because of the hyperinflationary environment and all the other challenges. Could we potentially be looking at an uninvestable geography at this point?
It's difficult to say. I mean, look, anyone that's been following the Turkish lira will know that it's pretty much been in the free fall for years, right? And so the idea of putting your money into a country where the value of any of the assets in that country are just devaluing on an international basis, that's questionable in the first place, quite frankly. So certainly this doesn't help the narrative, but it's something that anyone that enters into that region in the first place and invests into that region in the first place will probably know that there are some inherent risks.
Yeah.
And so if you're pulling out now, maybe it's one step too far, but this isn't an area that has been completely stable over the years and suddenly this has happened. It's been relatively unstable, in particular on the currency front, for a long time.
Indeed, and we will keep a close watch on that. Thank you so much for your time and for your insights today, Joshua. Much appreciated. That was Joshua Mahony, Chief Market Analyst at Scope Markets, with the Global Economic Week ahead.